Good morning, everyone. Welcome to another episode of the Mizuho Week Ahead. I'm Woon Heng, market economist at Mizuho Bank. This week's theme is steeper costs. We were certainly not short on central bank action last week. The Fed proceeded to cut by 25 basis points, and the dot plot has signaled 2 more cuts for the remainder of 2025. While having only one dissenter was surprising to some, it was certainly not too surprising that the likes of Stephen Mirren went with a 50 basis points dissent. Within the various decisions, there is increasingly variance within the policymakers' calculus. Despite these differences in opinions and decisions, the common theme appears to be that of a steeper yield curve, or at the very least, worries about a steeper curve. For one, even the likes of the BOJ surprised at the end of last week. With 2 dissenters, despite the fact that the decision to stamp pad was already widely expected. Crucially, they have signaled that they will sell their ETFs at the pace of 620 billion yen a year. While the pace of this quantitative tightening may be measured relative to the size of their holdings, the Nikkei's slippage last Friday is telling of the market worries around the potential constriction on the economy. These concerns were perhaps best reflected by Governor Ueda's presser, as he said that he needed more data before deciding on his next move, and highlighted elevated external uncertainty. The Bank of England was also in on plans to alter their QT process despite standing pat. The Bank of England has skewed their sales of glitz away from the long end by limiting it to 20%, while also slowing the quantity of sales to 70 billion a year instead of the current £100 billion annually. Higher than expected borrowing in the UK for August also continued to reflect substantial budget woes faced by Rachel Reeves, which resulted in a surge in the 10 to 2-year glitz premium. In Norway, the Norges Bank, which also cut by 25 basis points, signaled caution with only 1 cut each year over the next 3 years. Down under, the RBA was hit with a dismal jobs report with sharp decline in full-time roles, and they may be pondering if delaying easing will have larger costs down the road. Meanwhile, China did not miss out on the need for stimulus as they rolled out plans to boost services consumption across sectors ranging from sports, tourism to healthcare. Monetary support will be given via the PBOC's re-lending facility, and the banks will be offered lower rates to back lending in these areas, while administrative support came in the form of more visa-free access. Admittedly, economic momentum in China for August slowed more sharply than anticipated, and loan growth also fell short. China's 5% GDP target is at risk, and more support may be on the cards this afternoon. Over in EM Asia, Bank Indonesia undertook a surprise rate cut last week and also took on a burden-sharing arrangement with the fiscal authorities to shoulder half the interest costs of certain government programs. The market reaction of a steeper yield curve and rupiah underperformance was certainly par for the course. Ongoing changes to regulations are more likely than not to affirm close fiscal and monetary ties, which portends further rupiah weakness. Looking into the week ahead, it appears to be light on the data on the G3 front, from revisions to US GDP prints, US durable goods print, and a PCE deflator outturn at the end of the week. Nonetheless, even without data, markets will need to pass through the outcomes of the Trump C call, as well as various legal challenges, which could accelerate changes to the Fed's board. Even without data changes, the Fed's response function can still be subjected to changes via personnel. For more information, please refer to our week ahead publication or contact your respective sales desk and RMs. And for regular notification on our market views, please subscribe to our channel and hit the notification button. Thank you.